In this presentation, we will continue on with our comprehensive problem entering information into tax software for a relatively low-income individual. This related to state income tax refund and gambling income. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on our test 1040. We have the single individual. We currently have two dependents. If we go to page 2, then we are currently at wages $20,800. We've got the tax exempt. We've got the interest of $1,600. The dividends $500 for $22,900. We have two other pieces of information now related to types of possible income: state income tax refund and gambling income. We will typically get a 1099 for these types of income. This is from the 1099-G, what we'll typically receive if we get a state income tax refund. Of course, the 1099s representing the idea that we're going to have to report this on the taxes. It giving us the payment, we're getting information from someone else who gave us money, reporting it to the IRS, telling us that we may have to report it on the taxes. Now, note that when we think about the income related to the state income tax refund, it's a little bit tricky, remember, because the state income tax refund is only something we have to include in income if we got a benefit from the prior year. And if you think about it, this makes sense, because the state income tax only is there if we're in a state that has income taxes, and then we would make an overpayment just like we would on the federal. We'd get a refund then from the state. Now, this only happens, of course, for certain states that have state income tax. We're concentrating here on the federal income tax, but we want to consider this situation because it often happens that we have a state income refund on the federal taxes. Now, if you think about it, the refund should represent only an overpayment of how much we paid in taxes, meaning if we owed so much tax to the state and we paid too much of it, all they're doing is giving some of it back that we overpaid. Why is that income? That shouldn't be income, because all they're doing is paying back the overpayment. The only reason it would be income is if we got to deduct that overpayment. So in other words, on the federal income taxes, we got to deduct the state income taxes and then got a benefit on the federal income taxes last year because of that deduction. And now we got a refund. And so we didn't actually pay the state taxes and we took a deduction we don't need. The IRS lets us do that, take the deduction when we make the payment generally. And then if we overpaid and we got a benefit from that tax payment, we have to include it in income and pay taxes on the income for it. So in this case, obviously we probably didn't get a deduction for it because there's no Schedule A. So I'm going to show that by just entering it into the system, and note that it's not going to basically make any changes, and note that that could happen if you're entering information into the tax software, and you got to be aware of why that might be. I'm going to do that by going to the Schedule 1. This is where we're typically going to see it. So we're going to see the taxable refunds and credits here. I'm going to jump back to the input screen in this software. Software will differ in terms of what the income screens will look like. We're going to say that this is a state, we'll say state of California tax refund, and we had a state income tax refund of $600. So note, I'm putting it into the system here. This is input into the system, and you could be using different software and you might have the same kind of issue. You put it into the system, you go then to the forms, and you say, nothing happened. There's no income recorded in the line item I would expect to, the line item I jumped from. And the reason is because the system's saying, hey, I don't know that you got a benefit from it last year. And if it's the first time we entered a tax return into the system's not going to know at all whether we had a refund. If we were to roll forward the information from the prior year, then the software would basically know and be able to pick that up, whether we should include it or not. Typically, it would only be included if we got a deduction last year on the Schedule A. So if you're doing a tax return that doesn't have a Schedule A, meaning itemized deductions, we're not itemizing because we don't have enough of them, we're just taking the standard deduction, it's unlikely then that the prior year we itemized, therefore unlikely that we got a deduction for the state taxes, and therefore we probably don't have to include it in income. So that's just something to be aware of as we're entering this into the system. Now we'll have the gaming income, which is another kind of miscellaneous thing that happens a lot. If there's any gambling winnings, some people could often be surprised that they get a 1099 saying, you've got gambling income, and you have to include that in the taxes. You may get to deduct some of the losses, but typically we have to include the income. Now we're going to include that into an other line, once again on Schedule 1. So we'll include it in other. We'll jump to that input form once again. I'm going to go to other income, and we'll open this up, and we'll say that this is 1,000 for winnings, we'll call it. We might want to put where we won from the casino or something like that. And that's what we had for our winnings. If we go back to our forms, then for that, we're going to say, all right, there's the 1,000 and the additional income. That then is going to pull forward to the total, meaning we'll pull forward to Form 1040, page 2, in the income section. If we go up to the income section, here's the 1,000 in the income that has been included from the Schedule 1. We'll see also that the Schedule 1 is now boldened because we're going to use it. So if I uncheck this, it's still there. And if we go through this, we're going to say, all right, now the wages are 20,000. We've got the taxable interest, or we've got the interest, 1,600, qualified dividends, 500. And then we've got the other income, 1,000, bringing a total of 23,900. No adjustments to income, adjusted gross income then being 23,900. Then we have the standard deduction, 12,000 for the single individual. We have then the taxable income, subtracting the 23,900 and the 12 at 11,900. Then we have the tax calculation of 1,205, tax 1,205. So notice the income is going up now, and we then have a change to the credits that will be kind of above credits, which are going to bring the tax down to 0. So these are the credits that will bring it down to 0. Often credits being limited to that. Here's the payment we paid on our W-2. Credits and payments now being at the bottom of the form, they're being kind of equivalent. We're now at 0. What we withheld is going to be refunded to us. Not only that, but we're going to get a refund of the earned income tax credit. That'll be calculated typically by the system using tables. We typically rely on the system to calculate it for us. And then we have the credits related to the child tax credit and the other dependents credit. That adding up to 3,915. So we've got a total refund then of 4,836. Here's the summary. If we took a look at the summary, income, adjustments to income, no itemized deductions. We're going to take the standard deduction. We then have the taxable income and the child tax credit giving us, if we scroll down, here's our payments, and the earned income tax credit giving us the 4,836, marginal tax rate 12%. For more accounting information and accounting courses, visit our website at accountinginstruction.info.